And from a family standpoint, I think it's very useful to have an investment policy statement. As Mark mentioned up front, I would imagine that a lot don't. I think in the case of a pension plan or an endowment, there's a lot more governance structure around it, so you're more disciplined about it. But I think it's very, very useful for a family to have an investment policy statement. The global pandemic has created a lot of issues that are very positive to venture capital. So I'm longer on technology and life sciences than what I would typically be, but that was a function of the COVID-19 coming in. So it's more of a tactical change.
Good point on the policy can be pretty flexible, but I think without it, you can get lost. I mean, I've dealt with families where I think the one guy's, the client's comment to me was, as we were getting to know each other in the beginning parts of the relationship, was I ended up with a bunch of stuff, right? And there was a sort of a lack of purpose for the investments. So the policy statement helps guide and sort of keep you on track, but it doesn't need to be so constraining, and allows that flexibility to take advantage of opportunities. And I think that leads into our discussion with Fred too. In a industry where we got very much into sort of putting classifications and putting people in boxes, if you will, sort of, whether it's capitalization driven, style driven, country driven, sort of this check the box sort of allocation process. In our discussions the other day, I thought it was pretty interesting, Fred, how you guys were looking at things a little bit different. Maybe you can talk about that.
Thanks, Sean. So at Carillion Clinic, we're a health system in the western part of Virginia. I've been with the system 5-6 years now, and we inherited a portfolio that was completely outsourced. And what we observed in kind of analyzing the exposures and the way the portfolio is being managed, we had a policy benchmark that was comprised of 5 different sub-benchmarks, and about half of those benchmarks were custom. So we found that over time, the allocation and the manager selections that the portfolio was managed according to did not beat a simple 60-40 benchmark. Now, there's some benefits on the volatility side, slightly lower volatility, but what we determined is that the benefit of slightly lower volatility was outweighed by losing out on the return side. So what we proposed is a straightforward 60-40 global equity U.S. Barclays aggregate benchmark. And instead of having highly targeted 20% bucket to hedge funds, 10% bucket to inflation sensitive real estate, we have 60% equity target, 40% fixed income. And now we're looking at the underlying strategy. In other words, is a hedge fund invested in equity or fixed income? And that will determine where we put it in the portfolio. And our investment policy statement is fairly broad. As long as we're within the confines of a 60-40 and we can underweight equity or fixed income plus or minus 20%, and we choose how much we want to have in long short equity or private equity. And we also have a 10% allocation that we can invest in direct co-investment. So our committee structure, I think, depending on the organization, like at larger state pension plans, there's more structure, more of a committee type investment decision-making process. We use our committee for governance purposes. And as long as we're executing within the IPS guidelines, there's flexibility in how we manage the portfolio. And, we're seeing some traction there on the return side. I think the model we inherited was more of the traditional consultant model where you have 5 buckets and you fill the buckets. And then, the benchmarks tend to be, I would say, managed to where in each bucket, as long as you're beating a benchmark that could be custom and set a low bogey, the outsourced manager, would report back, we're beating our benchmark. But then in aggregate for the last 25 years, we're lagging a 60-40 benchmark that we could invest passively very cheaply through ETF. So our view is that if we're investing in alternatives and have a diversified portfolio and it's not beating 60-40, then what are we paying for exactly?
Anders here, Fred, it resonates with me and from our last conversation as well. The thing that strikes me is, as humans, whether it's the periodic table or asset allocation, we just love our buckets. And I just came out this morning from a board meeting with an overseas pension client. We agreed to do what, the host of this meeting has said, the alternative approach to a unified theory of asset management. We agreed to do a rework of the risk allocation. And the reason is really that we found that trustees, or even if it's a family office, if you think along the ultimate benefactor or the owner of the capital, if you don't understand the definitions of the classes that your investment team is running, it loses its purpose to a large degree. So we've done this in the past and now we're doing it here. And the idea we're proposing is we're going to work our way through, like Bill said, the correlation question of internal and external correlation, but not in the sense that we're trying to measure if it's 0.33 to a certain stock market. We're backing it all the way home to saying, okay, in our real estate portfolio, the underlying tenants for these type of property, are they retail? If so, what is retail correlated to? Well, it ties to GDP. And then we back all the way in and we go back into a alternatives product and we take the same review, whether it's a hedge fund and so on and so forth. So I think there's a real danger in being too, as a little internal club here with everyone on the call, we developed this awareness and knowledge and take things for granted. But at some point we need to just go back to and say, how much of this portfolio is exposed to if the world is going to go better or worse? And the reason we do it this way, sorry to be long-winded here, but the reason we do it this way is, although I agree with Bill's point about the 60-40 portfolio, very few would agree that in the last 2 years, we walked a really narrow plank, 10,000 feet up in the air. Hence, that's going to be fine in the future. Or we don't discontinue our hurricane insurance because there were no hurricanes last year. So underlying that 60-40 model, there is a real concern of how much pain am I willing to take? Not on average over the past 20 years yesterday. I assume the family offices are similar to pension in that next year is more central, meaning it may not have happened, but can we stomach the pain? So to some degree, we use alternatives, I think, similar to you. We have a return requirement on them, but if they take us away from that link to the public markets or general economy, we don't need the same returns that we get from S&P. So, and I think it's just a way to think about sort of building models away from, if we all run our old Markowitz modern portfolio theory method in one way or another, the end result is going to be pretty similar. So our goal for mid-year to switch that. Yeah.
Might I suggest, and I offered when you did your video, that you need your own deep dive on some of these nuances. So
that's a polite way of saying shut up now.
No. I do want to give everybody the floor, but I do want to give you also your floor.
That's perfectly fine.
But thank you.
Thank you.
Fred, the one thing we were talking about the other day in this maybe a little bit different look at the asset class, again, looking at the underlying investment itself, let's say being equity. The one thing we didn't talk about there is the sort of the liquidity profile of the instrument you're investing in, right? You may have equity exposure, but how do you think about sort of that liquidity profile?
Sure, that's a great question, because as a health system, we have greater liquidity requirements than I would imagine most family offices and endowments, we issue debt. So we have rating agencies that look at our balance sheet, and they get uncomfortable if we have too much in illiquid investments. So we've had, but at the same time, they don't tell us how to manage our portfolio. So we have a self-imposed restraint of 25% of our portfolio can be in illiquids. And we prioritize that risk bucket according to where we see the most value, whether on the equity side or fixed income side. So now we have more of that 25% illiquid bucket on the fixed income side, just given where rates are. And then, part of that is in direct co-investments with some equity investments and more in the early stage venture side. And that's one of the restraints that's in our IPS. As long as we're within a 60-40 framework and we're not exceeding equity allocation of plus 20% or minus 20%, and we don't have an illiquid bucket above 25%, then we have pretty much flexibility to identify managers and direct investments within that scope.
Interesting. And it kind of leads me into the conversation with Jonathan. Bill was talking earlier about expectations for fixed income returns when you've got, rates where they are. And historically, from a asset allocation standpoint, you had, the bond portfolio was your sort of that conservative diversifier to help with volatility. And in this environment, that's the toughest part of the portfolio to sort of manage. And Jonathan, we were talking the other day, I thought you had a really thoughtful way of doing it in a less liquid market to look at sort of the liquidity profile and plan for it a little bit better. Maybe if you could talk to the group about, what you're doing on that front.
For me, to Sean's point, it all comes down to planning, in my view. In this market, everybody knows rates are low. You either go into equities and take on the equity risk to try to get some yield there, or you accept the low yield environment. And so what I've done is sat down with families, and we basically built out a liquidity plan over time. And so if you take a look at your alternatives, whether it's your private equity, your venture capital, or your private debt, if you can sit back and think about it holistically and design a portfolio where you line up vintages almost in a laddered portfolio of vintage expirations, expected distributions from these funds, you can create an illiquid portfolio that provides a regular liquidity. And so that's what I've done with a lot of my clients. Is we try to look for unique ways to structure a portfolio away from 60-40 for whatever reasons they have. We combine the illiquids in there, but in such a manner that they can provide regular liquidity over time.
Just curious, maybe just throw it out to all the panel. In this low yield environment, how many of you sort of look to the equity market and dividend payers as supporter or help in meeting some of that income need, if you have it, some of that cash flow you need for the portfolio?
Sean, Andrew Randak here. One thing that people have left out, and for good reason, is the before tax, after tax element of a lot of this discussion. And I don't mean to allow the tax tail to wag the dog, but there's a huge difference between an endowment that doesn't pay any tax and a family office that does pay tax. And what we found last year was very effective for the families that I work with is using equities as a source of liquidity for spending needs, because if they were long-term positions, you were only getting a 20% hit from Uncle Sam. Whereas if you were getting regular income, whether it be from a REIT, whether it be from a private real estate fund, whether it be from dividends, non-qualified dividends, you ended up taking a huge amount of money or losing a huge amount of money to the government by not using long-term capital gains as a way to source spending flows. So it's a little counterintuitive, but it's something that could take 100 basis points off your total return of the year, 150 in some cases. So you have to think differently in that regard, particularly when you're a family office and you got to pay taxes. So.
Andrew, one thing I'll say too, to your point on taxes, if you're a family office and you're doing advanced estate and tax planning, a benefit of consolidating K1 income, especially if you can factor what's return of principal, offsetting management fees, losses. Again, with tax rules, not everybody's designated a trader fund now, but where you can get those designations and where you can help combine something coming out into your K1 can also be, again, another great way why I like to use alts as income generators.
That we use from time to time is derivatives, particularly on the future side, because you get the 60-40 treatment on those. So, it may not be right or appropriate, for everyone, but where you need to get exposure, sometimes, the tax advantage of using derivatives can also be helpful.
With private placement life insurance, because look, at the end of the day, you're just putting a wrapper around an inefficient product. And I think it's always been fairly popular with family offices. Always talked about it, but they haven't really done it so much. But with rates going to be going up and with the environment we're in, it's really only about a 50 basis points drag. And, you look at a credit fund, it's kind of a no-brainer if you have the ability, the amount of money to do it. So many of the family offices that we're working with have been implementing that. And again, it's objective. It's not subjective. It's objective. If it fits your category, it makes sense.
I do see that Eric Lindbergh is on, and technically he's on the panel, followed by some people on the alt side. Maybe we could, Eric, if you're there, you could jump on, and if not, we can go on to Eddie.
The interesting thing about this is, how do we translate this framework and construct from public markets to private markets for us? Public markets is we manage outside at the moment, and so I'm in charge of all the illiquid stuff. And how to create a theme and a thinking pattern about the correlation and diversification in our portfolio. We have sort of thoughts about trying to diversify geographically what we're doing, taking political risk in account, and that's then subjective, not objective political risk. Because some countries are much more comfortable investing in than others, because we know a lot more about them. The stage in which the investments are in, whether they need capital or whether they give capital, and sort of the risk profile of the industry, and we develop themes around those, and that's sort of in our not written out, but in our sort of internal policies. That's how we try to diversify, and I'd love for other perspectives to manage risk and return essentially on the illiquid stuff, right? Because there's no benchmarks, there's no universal papers written on those, and it's very hard to quantitatively and objectively say what the correlation is between assets. So I'm looking for folks who are looking with the sort of the institutional outlook for your public portfolio into the private portfolio, particularly family offices.
Well, just maybe one clarification, so that they can answer the question properly. What is the percentage of the alternatives as like a percentage of the corpus of the asset base?
For us, it's over 50%.
You say something about how you classify it today in terms of, let's say you held a private equity manager focused on LBOs. Do you disseminate how far do you go down into the dissemination of what you get in the bag? Because sometimes, as we subscribe, it's a black box, but do you get...
Yeah, we very much look at geography. We actually sort of divested a lot from investing in managers to investing direct, because a lot of investments we had were geographically agnostic and industry agnostic, and so anything could end up in that bag. Right. And it turned out that a lot of capital flow to the same ideas, and then you have a significant over concentration of industry, investment type, and risk return. And by doing it direct and writing tickets directly, you can much better at least know what you're buying and know what's in the bag, right?
I'd be glad to share with you at another time how we do it if you're interested. But I think it comes down to that your complaint is justified, right? I spent some time with the two main, if you think, partner group and Blackstone over the past quarter to look at some of the products. And it's astounding that if you want to trip them up, all you have to say is describe your thoughts around your portfolio construction for me. And it feels like you're talking to a 10-year-old. There's so little thought going into it. And maybe we as an industry are responsible because we were happy to just buy it until now. But there are some ways.
Yeah, I'd love to hear more about it and have a deeper conversation about it. Maybe a deep dive, as Mark always says.
Maybe a European perspective, Eddie, at the same time. You might want to, how should we be thinking of Europe today?
What's that? Sorry.
For both of you. And those, how should we be thinking of, just basically geographically on the allocation, Asia, China, ex-China, Europe?
I mean, obviously that's a far too vague a question to answer very directly. But I think, over the last number of years, people have sort of shunned Europe, particularly in public markets, and right now that's probably coming back a little bit. In private markets, there's no such thing as a European strategy, right? Like, some people still buy the book "Let's Go Europe" and try to do 15 countries in 6 days. It's not really the way to visit it. Same in investing, right? Europe is so many different geographies within Europe because there's no such thing as one real Europe. Particularly now with UK going out, there's UK-centric strategies. There's Germany, there's Scandinavia, there's Southern Europe, and so we see a number of different attractive pockets: Southern Europe, Scandinavia, Western Europe, where we are comfortable investing in. But it's that you can't really generalize that also, right? We have a lot of domain knowledge in, for example, Western Europe and Scandinavia. And a lot of people don't, and if they don't see the same opportunities.
Hey, Eddie, it's Rob. Just a quick follow-up on that. Are you all in favor of more of a basket, in terms of a regional basket, or if you feel certain on a sort of country only? Can you speak a little bit about that focus? And Mark, you got some interesting international folks on this. That'd be kind of interesting to exchange some notes on.
Yeah, the thing is, in particularly when you speak about Europe, it's not such a thing as a country-only investment, because a lot of companies you will invest in are internationally diversified companies, right? There's no such thing as I'm going to do a pure Portugal play in retail. That doesn't happen because it's probably a large Spanish player who owns retail in Portugal, and you buy into the Spanish player. So we diversify across geography in a different way by industry. So when we like to be in a certain industry, we would like to be in some part of that industry, and then we point out a part of Europe where we want to play, but it also depends on the industry. So I don't think there's regional sort of baskets that we sort of design.
And Eddie, that industry focuses across the public portfolio as well as the private?
No, it's completely separate and separately managed.
On the public side, are you getting more? Is it more just getting the country exposure, or are you trying? Is that what you're struggling with from an allocation standpoint?
That's what we're struggling with from an allocation standpoint, but it's also I'm relatively little involved on the public side. That's all outsourced.
There's one free lunch to be had with Europe, to generalize, because I agree with Eddie that if you took Scandinavia as an example, most of the market cap in the public markets and even in the private side, it's a small country. It's where Santa Claus refuels on his way to the North Pole. But, most of the revenue is exports. It's Skanska, it's Atlas Copco, Ericsson, these names. They're not particularly dependent on the 8 million Swedes to buy their mining equipment. So that just supports the point. But the one free lunch I see if you're a family office or an institution in the US, you have your liability side in dollar. But while we invest in the dollar denomination, the currency could move 10, 15% without a breath. So you could just think about it as a way to say, I get a little bit of a reduction to my US health of the US economy by just taking on that euro denominated risk to some extent. It doesn't support you if you have a dollar based liability, but it still reduces your risk. So that's one way of thinking about it. But I think really currency is the only generic lens for Europe that exists.
Right. You know, in terms of kind of private opportunities around the globe, people have sort of been bringing back up the whole China situation as well, which there's obviously some political risk there, but it makes me think about like Ed Greffenset at the Dietrich Foundation, and the Dietrich Foundation has been, as I understand, one of the best performing foundations for a long time. But Ed goes over to China, I don't know, like 3 or 4 times a year. So he's got very deep domain expertise, in China. He's got a lot of great contacts there. So I guess, maybe one question, for the group is like, kind of what do people think about China now? But the other question is, at what level of domain expertise do you feel is important to have, especially on the private side? I mean, I'll just say parenthetically that I've got some experience previously in the blockchain space, and that's an area of interest for us right now. So I'm somewhat comfortable, but at the same time, there's so much going on there that I feel like I still need to dig deeper. So, but anyway, thoughts about domain expertise, China, etc.
Yeah, Bill, I'll give you 2 cents that I have on China. I agree that you need domain expertise. We don't have it. I know that, it's funny you mentioned Dietrich Foundation. That's right here in Pittsburgh. They, Dietrich himself loved China. Ed Greffenstedt has loved that strategy as well. And to your point, it's worked out phenomenally for them. I think unless you're boots on the ground in something like that, it's very hard to have the expertise. I think that most of what we do, I find the families want to stay in sectors that they know. So manufacturing family loves to stay in manufacturing, but they'll branch out a little bit to ways of technology to improve it. A pharmaceutical family wants to stay in pharma. So that's kind of where I see domain expertise playing.
I'd add to that maybe that I look for opportunities that are not too reliant on that country risk, meaning if I'm in China right now, I'm evaluating a venture fund in new mobility. But if their investments were reliant on the commercial success in China alone, we probably wouldn't be there. The reason I'm there looking is because it's a effort which is backed by Geely and SK in Korea. And I see that it could have been in the US as well. But here I have industrial backers selling a few million cars per year. Then the fact that it's in China, there are dimensions to it that impact the situation, but it's not, I don't really like the idea of, I want to go to China, I want to go to somewhere for a particular reason. I mean, the issue that when you rose with the blockchain earlier is a little challenging one, because I'm okay that we stay in domain expertise on evaluation of managers, but you need to get that competitive landscape so you don't own the blockchain technology of yesterday, right? And the question is, where does your responsibility begin and the manager's end? And that's a tough one.
Hey, Bill, on the China side, it's going to be particularly interesting, just now with the new Biden administration, from a trade perspective, from a securities perspective, we're there in a couple of principal investments. I think there's a safe area, strangely enough, from the growth to the mid-market. But then once you get into the bigger areas, as you've seen in the case of, Jack Ma, what he's experiencing in-house there, within China right now, it's rather delicate. But that said, I mean, China's a huge force, and it's something which, if you don't have a strategy around that, you got to kind of take your head out of the sand. But it's I'm following what you're saying, but from a private perspective, I think we pick our shots and recognize certain areas, for both growth, but certain areas. There's an art of being happy with achieved return and not pushing it more.
I had a question for the panelists. Seth Klarman was out today saying that the policies of stimulus for the last couple of years, but really going back even longer, have distorted the markets in terms of how we think about risk, and how we're investing as if there's no danger in some of the things we're owning. I'd like to get your guys' thoughts on that. I thought you'd appreciate
I don't
that,
know.
Bill.
I don't know if I'm swinging at a softball or a grenade. Yeah, no, I think, Stephen, it's actually a really interesting question. I think that we're almost like entering into like an Alice in Wonderland type of environment where policy objectives are going to drive opportunities to a much larger degree than ever, because people's thinking, again, like the people that matter, like Yellen and everybody else, their way of thinking about debt and things like that is just so different than I think, probably a lot of people, here on the call. But it seems as though that, the spigot's going to be open for a long time. And so, to the degree that, that you can sort of follow the money on this, I think that that's probably going to be a way to play. And it could, you guys tell me if I'm wrong, but I think it almost could be like a self-fulfilling prophecy that literally if we throw enough money, at stuff, the economy is going to recover, sectors are going to recover, things like that. Now, of course, you've got that huge debt, that's looming out there. But once again, I think, I'm not sure if actually Yellen said it, but it was quoted in the Wall Street Journal the other day that, with, kind of quote unquote, with interest rates so low, we have to act now and we have to act big. That's a paraphrase, but I think I got enough of her words in there. And, that has, if that's true, then it really has some potentially pretty profound implications on where things are going to go.
Andrew Randak here. I brought this topic up before at 361, but it's more clear now, I think, than ever that if you're worried about modern monetary theory coming down the pike, you're about 10 years too late to a certain extent. I think that the quantitative easing that happened 10 years ago, the Fed's balance sheet is now going to be permanently, or most likely permanently, north of $5 trillion. And there are some smart people out there now talking about a $10 trillion balance sheet, which sounds ludicrous given that we were at less than 900 billion 15 years ago. The question that sort of the devil's advocate question on that front is, what is the right size of a Federal Reserve's balance sheet for the world's reserve currency and the largest economy on the planet? Is it $900 billion? Because a lot of the thinking that drives asset allocation and asset pricing is based on orthodoxy that comes from an era when the Fed's balance sheet was tiny relative to the economy. And if people think that it's going to go to 5 trillion, then okay, then you've got a lot of reasons to adjust your asset pricing models and what you think is the correct equity risk premium that you should be, quote unquote, charging to make an investment. If you think it's going to $10 trillion, then your number is very different. Your discount rate is very different. The amount of liquidity in the economy that's going to support your investments is very different. So how we view the fundamental role of the Fed's balance sheet in the economy has an absolutely direct impact on asset allocation decisions today and for the next probably 10 years.
I guess one of the things that Seth was asking is, are we being conditioned not to recognize risk? Which is an interesting discussion for this group as we're going into, more private stuff, and we're even in the public markets, risk has to be thought about differently. The idea of just rotating to value after growth has had a big run used to be okay. Is it today? And how do we think about that? So Fred or Jonathan, thoughts on this?
That's related and also related to Seth Klarman. I read that he is investing in Bill Ackman's SPAC, which I thought was interesting because Seth Klarman is a bottom-up value manager, yet he's investing in a SPAC by definition without a target acquisition at this point. So, the SPAC market, I think, is representative of what's happening now with maybe some of the exuberance, but at the same time, we've done a couple SPAC deals with our managers. At the same time, I don't think it's fair for anyone to paint the SPAC market as one investment, because ultimately you're investing in individual companies. Some will do well, some won't. But as a trend, I think that's something that's probably going to stay, and it's can be a cheaper means for a private company to go public. And since there's a lack of public companies in general over the last couple of decades, that development's probably positive. I think I'd be curious on other views on that.
Rich Sobel, did you have a hand up there?
Yeah, I wanted to say something. It's a great discussion. A couple of quick points. I'm involved in a family office and also on a university endowment. And I must confess that, behavioral economics, we found ourselves in the spring of last year underinvested. And it's partly because of the way the principals felt about risk and the way the academics on the endowment board felt about risk, which I think turned out to be a mistake. And we've now corrected that by getting invested. That's sort of a lesson that some of you or many of you have probably experienced, but it wasn't very good. But in looking at the private markets, we've decided that, or on the public markets, we've decided to become much more passive in kind of increasing our exposure. The active managers just haven't delivered. And so we've decided to surrender and be more passive in a number of the categories. So we've also decided that this is a fundamentally good vintage. And do we know that for sure? No, we just see the pattern that we've experienced in the last 30 years is that the year or two after an economic crisis turns out to be a great vintage. And the credit managers that we've talked to and the private equity managers and the venture managers, we're looking for good managers, but we're trying to increase significantly, systematically our exposure. And, in our view, we'd been underinvested in alternatives. We maintain liquidity at 5 years of the family office spending, which is kind of one of the rules of thumb that allows us to now take more illiquidity risk. But we're also setting ourselves up to do much more direct investing alongside the funds that we're investing in the venture space, especially, because we think that there's just going to be great opportunities, and we want to sit on the shoulders of some of these early stage VCs, especially in sectors that we like, and I think many of you like, these impact sectors and cannabis sectors. And there's just tremendous stuff going on, and we're going to get some of them wrong, but the principals have gotten conditioned by some of the success we've had in the last year. So, and I think that one last comment, there's some really interesting entrepreneurial managers, but we're trying to strike a balance between established managers with 20 plus year experience and some emerging managers, because honestly, some of the emerging managers are exciting, but they're not going to work out. And some of them are going to work out really great. But that's one way of acknowledging that even though they all look good on paper, the emerging managers involve a little bit more risk. So we're trying to strike a balance. But that discussion is an ongoing discussion that our principals are quite finally becoming much more involved in. So, which is really exciting. But private investments for us is basically spiking.
Good points.
Other thoughts, particularly for others who haven't really chimed in yet? I don't know. Scott, do you mind sharing how you're seeing the world?
So I'm with a single family office. I think all the points, this has been a great discussion and stuff that I've been dealing with quite a bit over the last year or two. Our family office is about 5 years old in its current form. And, we started out with an asset allocation policy that had some targeted allocations to a handful of things that were fairly specific. And over the years, that's dwindled quite a bit for some of the reasons that a lot of you have brought up. I think our investment policy has become a little bit more flexible. I can't remember who it was. One of you kind of made the point that you've shifted more towards, just kind of the traditional equity and fixed income asset classes. And then, we look a little bit like that now. We sort of have now kind of more of a 70-30 type benchmark. And in terms of asset classes, we've shrunk it all the way to where we basically say things are either growth or deflation hedging, or they're diversifiers, where they fit somewhere in between those two things. And so those are kind of that now includes, it's kind of a catch-all that includes all the things that you can't really match up with a traditional asset class. So, doesn't have a lot of equity beta, doesn't have a lot of correlation to rates, that we kind of look at as on a bottom-up basis. So, and the way we benchmark those is they need to outperform kind of like a 50-50 equity fixed income allocation. And so we try to, hold ourselves to that standard. And again, one of the challenges is that's been brought up already today is taxes. We spend a lot of time thinking about that, and it is hard to find those diversifying strategies that we think can actually do better than passive mix of equity and bonds, especially when you factor in taxes and just the challenge, frankly, of getting up to speed and managing the relationship with a manager that does something really niche. So someone brought up the point about China. And I think all of this, in an ideal world, I could get up to speed and do the boots on the ground, but that takes a ton of time and a ton of effort. And how much can I really allocate once I've made that effort? So I don't know. My asset allocation sort of career trajectory has become a lot more simplistic, a lot more boring, frankly. But we've started, I'd say the only thing that we do that's somewhat interesting now in the equity side, we do have some passive equities. But we've actually split up the world a little bit more by sector and about business model. And so we've kind of determined that, there are a handful of sectors that are frankly just higher quality. So the lower, less capital intensive sectors, we think that those are just fine to own passively. And, there are a lot of great companies in those spaces where I think, we should be comfortable paying kind of a fair price and just owning for a long period of time. And those are all the traditional kind of cash cow businesses we now do passively. And then on the flip side, things that are more capital intensive, we feel like those should be done a little bit more actively. And we're becoming a little bit more, I think we're using that framework. Also, in active managers, do we want to do it, public or private? And we have some views about what makes more sense there as well that are becoming a little bit more, I think, well articulated than in the past. So, I think the geographic lens, we've in the past had, kind of a developed versus emerging, and we've found that to be a tough, just too simplistic of a view. But liquidity is the other major concern that I wrestle with. How do you apply that? We have a real, I'd say our principal is not super thrilled with the performance of the privates relative to what could be done in the public markets. And obviously the public markets have done super well. So that's challenging to, I try to be cautious about how much of that can continue, but we're having a hard time, justifying increasingly hard time justifying the illiquidity risk that we're taking on, and are we getting compensated for that? So again, that leads us more to kind of more boring and more straightforward. And the other thing about liquidity too that I learned this year is, that's changed my thinking a little bit. I mean, I was more, I think, open to taking on a liquidity risk, but going through the experience in March when I wanted to add money, it's not just about liquidating things and getting money out and funding different liquidity needs. It's about what can you do offensively. And I found our more liquid passive equities to be a lot of the things that drove our performance over the last 9 months or so. We were proactive in that area, but we were still somewhat limited in what we could actually do, just because you can't add to a private manager on a moment's, in a short time frame. And so I think having some liquid, kind of, again, more boring options, but buying it at a really great price was really advantageous for us.
Well, you covered a lot of ground there, Scott. You should have
Sorry.
No, it's good.
Yeah.
Who wants to go next after that one?
Mark, Scott's a new panelist for the next session.
That's just because he plays your thesis. I knew that was going to happen.
Sorry.
You and Rich see the world a little differently, but it's what makes for a horse racing pageant.
To Scott's point about reducing the complexity, I was on a call earlier today with somebody who's advising a robotics company on a valuation thing, and he said they kept expecting us to get to this crazy complex 40-factor valuation of the company. And I said, no, it's really you just have to look at one or two factors that are really driving your profitability and derive it. You don't, just because your business is complex doesn't mean your valuation needs to be complex. And I think just because investing is complex in itself, it doesn't mean asset allocation has to be a complex exercise as well.
That's a great point, Andrew. There's so many things that are hard about what we do. When we can eliminate the stuff that makes it harder, there's real genius to that. I sent Scott a note to that effect, that there's genius in simplicity. And, I think sometimes we make this a lot harder than it needs to be.
Stephen, then you'll probably like this. I'll just challenge the idea of what we're up to here for a second, but it may be up your wheelhouse. If we look at the amount of analysis we spend on the right managers or the right asset class, and then we look at the global growth versus the valuations, and suddenly we realize that return that Scott mentioned hasn't really come because we invested in companies that suddenly performed better, right? It's come because the capital pool I propose across the globe, the big institutions need to meet their liabilities of anywhere between 4 and 8%. And if you have a yield on bonds of around 0, it's going to be short work to conclude that the money will have to go to a meaningful degree to equities. So that's not even touching why you should own equities. It's just a function of what disposable alternatives to the market participants have. If you need water, you need water, right? So that's just something I find a little challenging and somewhat underanalyzed. It's just that the drivers are less about the companies these days and more about the investors.
Well, but what's interesting, Anders, is a very good point. We actually haven't seen those capital flows happen yet. If you look at capital flows, we're continuing to see, in the US market anyway, a move towards bonds and away from equities, which, it could be a powerful leg behind it if that ever happens.
Yeah, Sean, you're right. The flows have been totally pro bond in the last 12 months and negative on the equity ETFs.
But I wonder that's interesting because it's sort of to me, just logically speaking, it's sort of inconceivable to think of a rising equity market with negative outflows, right? But compared to analyzing companies, I think understanding fund flows is sort of the dark science of what we're doing. So I wouldn't challenge the statement, but I would.
Well, you know what it is, Anders. It's the construction of the indices, right? So the bigger are getting bigger, and it's driving returns.
Yeah, and that's sort of hard to argue against, if you will.
I just know, because there's so many voices, perspective there's the pension perspective, large institutions, but there's also insurance. And we just had our insurance guy just join. And Chris, do you mind? Although, where is he? There he is. You're at the bottom of the pack, now you're up at the top. So you missed everyone. There's been a little bit of a no violent agreement like we've had too much of in the past. People have different perspectives, so you can't go wrong, whatever you say.
Well, okay, but what's the question? I literally just dialed in. Apologies, I was in an investment committee meeting.
It's all good. Just hark back to the prep call, just how you're seeing the world, how you adjust in 2021, either risk returns, you and introduce what you do. You got that $1 billion book of a 90 billion general account.
Yeah, great. So I'm Chris Brown. I work in the investment department of Allstate Insurance. But my viewpoint is I'm in what's called our opportunistic group, which is, as Mark just said, about $1 billion of 90 billion. So I mean, we're tiny. Because of that, we're able to because we're small, we don't have to kind of be governed by some of the kind of insurance capital requirements. I mean, we're governed by them, but our stuff isn't as well rated, and it the rest of the kind of book can handle that for us. We sit adjacent to our private equity group, so we're doing kind of alternative special situation stuff, and our book, we slowed to a crawl, when COVID hit, but kind of in late summer, it started getting busy, and I would say now it's very busy. So, but perhaps one interesting thing where historically our minimum return in our group, opportunistic, was kind of 12-ish%. We're going to bump that down a bit, maybe 10-ish. Kind of in recognition of where rates are and kind of relative value. We found that north of 12, in some ways, we were being pushed into a risk neighborhood that we weren't comfortable with for our book. So for us, the sweet spot is coming down a bit. And we're looking at kind of the private off the run things and seeing good opportunities, stuff that isn't as heavily banked. So we're doing kind of senior debt down to structured equity. And so, I call it tweener capital, in between kind of traditional bank debt and certainly traditional equity. And we're seeing, but both on kind of growth situations that folks want capital that's not dilutive to their equity. We're seeing situations, and also kind of situations where there's assets we can lend against or get comfortable there's downside protection. But there isn't necessarily like EBITDA that a bank would step in and provide a traditional loan. So kind of in that in between, we're pretty pleased with activity right now. I don't know if that hit on some things you were interested in, Mark.
No, it's completely irrelevant. You can leave.
Completely irrelevant? Yeah. Okay. Well,
Yeah,
I tried.
Now, the thing is, you also invest in funds and directs. Are you getting good directs from your funds? How do you like that dynamic?
Yeah, so about a quarter, maybe a third of what we do is as an LP. The rest is, call it direct, but really the fertile ground for us. There's only 7 of us on the team, so we can't be expert in everything. The fertile ground for us is to co-invest and partner with people for that other kind of 60 to 75%. So really, it's our LP investments. We really focus them. One of the key criteria is if whether that GP can turn around and provide us some co-invests or other opportunities.
But are they doing that right now for you?
Yeah, actually, I would say just starting certainly since the beginning of the year, in the last couple of weeks, it's even accelerated. That we're seeing a lot of deal flow on the kind of co-invest side.
Gotcha.
Hey, Chris, do you have enough history on funds versus directs to be able to do an attribution? In other words, are the directs giving you a positive spread relative to the funds?
in terms of kind of buying our expenses down.
In terms of like return generation. Are you getting more juice out of the directs than out of the funds in aggregate?
Yeah, so I think part of that would be, you know, are we able to pick, or are we ourselves able to pick the winners versus the losers that they show us? We don't. So my group is a little over 4 years old, so it's difficult to say. I will say more directly that I mean, I'm sure as everyone on this phone is trying to do, or the Zoom call. I mean, we view it as a way to reduce the expense burden, but that said, I mean, we really struggle. Our private equity guys say, "Oh, co-invest should be free," and understanding that a lot of times they get that, although I think that's changing. For us, the deals that we see, so non-private equity, we get reduced fees, but almost never do we get zero fees.
Right. Yeah, 0 and 0 is pretty rare.
Yeah, I mean, we're basically targeting half, whatever we're paying, half of full freight to get on the. I actually be interested to hear what everyone on this call, if it's a relevant topic, if people see that kind of difference between private equity and whether it's kind of, I mean, for me, kind of special situations, whether it's hedge funds or opportunistic, you know, kind of what fee structure you see on the co-invest side, because it's a battle for us.
Right. I can kind of look back to my Morgan Creek days and tell you that you're absolutely right. It ran the gamut. I mean, we were able to get some co-invests at 0 and 0, and then there were others that we paid, you know, full 2 and 20 on as well. It really depended on, you know, kind of the perceived juiciness of the deal, you know, how oversubscribed, you know, it was potentially going to be, you know, a lot of, you know, different factors that came in there. You know, I think relationship had a little bit of a factor, you know, as well. You know, some of the funds we had, you know, deeper, bigger relationships. We tended to get better fees, you know, on that. But at the same time, you know, it really ran the gamut. Although I didn't mean to put you on the spot by my question, but it was more it was kind of more aimed at sometimes the GPs are actually willing to share, you know, what they think are better deals when there is additional capacity, you know, in them, so that the LPs could co-invest. So it's not necessarily, you know, kind of your ability to choose, but it's whether or not the GPs are willing to share some deals that they think are particularly, you know, attractive.
Yeah, interesting. We haven't seen that necessarily. That it's only kind of the, you know, the better deals, so to speak.
Yeah. Because I think again, kind of going back to our Morgan Creek experience, is that there were any number of co-invests that you didn't want to do simply because there was more capacity available, and there was probably a reason, you know, for that. So you had to be careful.
I've seen that same thing where you always question why are the co-investing. What the trend that I've seen too lately is, to your point, some are basically 0-0, some are 0-20, some are 2-20. But lately, a lot of the funds, one, if they're a startup, they're usually offering, you know, whether it's a $200, $300 million firm, they love to offer preferential treatment on the co-invest. But a lot of these people now are starting their own opportunistic fund where they're saying, oh, no, instead of co-investing, we'll give you a 25% allocation to our, you know, opportunistic fund where you can double down your commitment to the best 10 of our 100 investments type thing for a VC. That's like the common trend that I'm seeing a lot of people take.
Fair enough. Well, we were sort of at this point. Sean, I was just thinking, going around the houses and seeing what people are excited. I usually say scared or excited, but I want to be excited. What themes or ideas? You know, you're and then maybe there's some even open syndication to get into, or oops, it just closed, but I was excited to get into. Just, if anybody could speak to that, like Anna Haskell, I haven't heard from you. what you're looking at in either in the energy or other markets, or, Eric, I think Eric's on another call with the CEO of one of the vaccine makers. So I hope he does come back so he can enlighten us. Any, or any continuation of the themes. Just want to get a few more voices in, like Rich, Ms. Pola, we've been talking lately, hope to talk more here. What excites you?
Yeah, I mean, so just going back to the theme, right? Like, we have a kind of an expression around the office, which is, life is a giant averaging machine and everyone kind of regresses to the mean, right? So you're starting to see tons of inflows of capital into the same areas, which typically has a increased level of competition and a compression of returns, right? So I think the SPAC bubble is going to be exactly that. It's a race out of, kind of greed, in my opinion, with fewer opportunities that are really well formed to actually deploy that capital in a short period of time. So that'll be interesting to watch over the next 18 months to see if this thing actually comes to fruition. So we've been avoiding it like the plague. That's one. We also don't believe in the misaligned incentives. Two, we've been focused on much more esoteric or kind of opportunistic strategies, right? So secondaries where we have, inside information, quote unquote, with good relationships to make informed decisions, a lot more capacity. And then also looking at, emerging strategies, one-off things that either our family will do on kind of structured lending, direct lending, or just kind of doing, kind of portfolio triage on our own and primarily tech, right? So, when we look at this, we're still looking for things that are lower correlation to the market, don't have a lot of interest rate exposure or inflation exposure. And then also too, looking in more kind of hard asset, hard goods outside of real estate, right? So we think that there's going to be a long-term boon with the new administration on, I would say, infrastructure development, equipment that has to support that over time, which leads to unique kind of opportunities on the lending side and financing side, and strategies there, transportation as well, infrastructure, things and logistics are going to be increasingly important. But from our standpoint, we think everything's overpriced, like most people on this call. So we're kind of waiting to see how that plays out. But generally from our take, we think the private credit space makes a ton of sense, especially in areas that lack correlation. And I think to Chris Brown's point earlier, where you have this kind of area of the J curve where people are not yet free cash flow to equity, we can get better risk adjusted returns. Makes a lot of sense to focus, so long as the only differentiating factor that you have is not the amount of capital you can deploy, right? So you have to be value add, bringing things to the table that give you an edge, that you can actually extract more value and price relative to risk. And I think the biggest thing that we struggle with, which I think most families do, is how far out on that risk continuum you want to take relative to the return, right? Does it make sense to try and go for 14, 15% relative to the risk you're taking? Or like, hey, I'm fine with 9.5, but in a more secured position with better rights and better covenant protections and the lending that we do, right? And that's a constant, debate that we have with our kind of investment committee as we kind of look at opportunity. So, that I think is a common statement. But the M&A activity world is interesting. So it also informs too, you want to take more equity upside or you want to take more downside protection. So it's just, again, like these are all kind of common themes, but we're excited about the private debt space. We're spending a lot more time in it and kind of niche areas. In areas that typically don't change over time, right? So mostly in consumers and alcohol and things of that nature.
And if you want to watch Saturday Night Live, I can click any of these for you. So, other thoughts? Ron, Ron Diamond, what are you excited about? Except for your Stanford platform. You're on mute. You're still on mute.
Getting that thing out of the White House.
I think that happened, right? Or what is that?
Yeah, I'm very happy about that.
Okay, but what do you want to invest in now that it's out of the White House?
Well, we're seeing with the families, single family rental has probably been the biggest trend that we're seeing. It's almost like mobile homes were 10 years ago. So I think with the demographics of everything, single family rental is going to become more and more attractive. Millennials are going to have 5 jobs by the time they're 30. They don't necessarily need to own. People want to be more flexible. So that's one area. And then with Stanford, we're putting together the Stanford Global Family Office Center. And basically what we're trying to create is we're trying to professionalize and institutionalize this industry because, it's my belief that, as venture capital and private equity disrupted the public markets in the 80s, I do believe that family offices are starting to and will continue to disrupt private equity and venture capital. Problem right now is that most families, I'm not speaking about the families on this call, but most family offices are very inefficient, very fragmented. They work in silos, and they really want to be together. So I think we're only in the second inning of it, but we're going to be putting together the program for the purpose of. I do believe that family offices with close to 10 trillion in capital, you get 65 trillion coming down from the baby boomers, the next gen. It's going to get bigger and bigger. People are going to start incenting these people more. The bright kids out of Stanford and Harvard are going to go to family offices rather than just Apollo. And I think you're going to see a major shift. So I think over the next 3 to 5 years, that's what we're trying to stay ahead of the curve and trying to change.
Ron, I second your motion on the recent news and feel good about my home country, USA, these days. But can I ask you, have you looked at non-performing loans and that side of the equation for residential?
Yeah, we do look at. We've really done too much in it. I just think the trend that I'm seeing, most of the, look, multifamily is going to always probably do pretty well, but it's kind of expensive right now. I think student housing and some of the self-storage are a bit saturated. I do think that some of the smarter families that I'm working with are really, really focusing on the single family rental. So I think it's a big opportunity, and I think we're still early in it. There's one family office that we work with, the Jaggi family office, and I'm happy to connect you with him if you want. But they've been doing this for 10 years, and they're way under the radar. But they basically pioneered this, and now the large family offices, they're really starting to look into this.
Yeah, no, I think it's such. I know earlier Mark asked for thematic ideas, and the thematic idea, I think, when we live in high value equities and stressed bonds, is this sort of opportunity to go idiosyncratic and say, what is the method for generating returns? Because if you're investing in a trend for rentals, your capital is actually not, the way I think about it, it's not generating returns from the investment acumen of buying cheap and selling expensive. It's, of course, buying at the proper price, but it's a effort arbitrage where returns are generated by providing a utility, right? So that's the resilience in many ways of these functional investments, whether it's non-performing loans. So, no, I'd love to connect at another time and learn more about it.
Sure.
Well, hey, let me jump in real quick, Anders. I'm curious on non-performing loans. We've been spending time in that space lately, and kind of the thesis. I mean, maybe everyone knows it. I mean, obviously there was a tidal wave of them created after the GFC that are still kind of, and they still kind of exist. And then the issue is whether COVID will create the next wave. And so I'd be interested if folks have found funds that they like there. We've talked to Carval. Lone Star is clearly a leader, though they're not raising right now. Talked to Angela Gordon and some others, but we think that may be I mean, it's still competitive, but we think that might be attractive.
I agree. I mean, I invested in one, and I'm a little cautious about broadcasting names.
Sure.
Just because it's an implicit endorsement, even if I don't, anyway.
Yeah.
The reason I enjoy it is because, many people have failed in this space because they think of real estate, and I guess this would be interesting for me to learn what family offices think, but the generic view is that real estate is a long-term appreciating asset. I'm invested with a manager who has the view that real estate is an inherently depreciating asset, and that you want to maintain no leverage and high asset velocity, with a mindset that that's how he extracts value from his process, which, similar to the others, is acquire the non-performing loans from regional banks, and then they take it in-house, process it, and sell it out. What these guys are doing that I truly like is that they're using debt forgiveness as the tool. And in this day and age of ESG, just to be bombastic on the call, how many times have you seen an investment that has a sort of 10-year average net IRR of north of 10, currently trending well over 20, where $100 million of your invested capital would result in $60 million worth of debt forgiveness on the part of the weakest borrowers of America? Because that's the side effect what they do. They acquire them. They, unlike banks who can't do it, they do bona fide write-downs of the loan, restructure it, and put it out again. And to me, that's sort of a nice ESG place to be. I think it's a highly GDP-centric strategy, but the comfort I take is I need a manager without leverage who has a disciplined approach on the sort of loan to value he's paying. These guys have a historical average of 60 cents on the dollar and now trending to 40. The other risk you have is the, as you know, the only time in history I think these assets struggled was after the robo signing of loans, where we had the foreclosure moratorium stay. But even in those days, on a bad day, you got to zero returns unless you were running around with leverage. So yeah, I'm sure I have more to learn from you in that space than the other way around, but I'm happy to share what I've gained.
Jozar, just take note on that for the real estate guys. Anyone else with the perspective? What's exciting them? I haven't heard from Ron Lusk or Reiner. Eric still's probably on that call. Anne, I saw your question to Ron. I don't know if you want to elaborate on that, or again, anyone else?
Yeah, I tend to, because, I'm a single family office. I'm not tending to look at assets in terms of allocation, and probably, I need to look more into that. But I think I'm looking at assets as what's cheap. And I think right now I'm extremely cautious in stocks, but not every stock is overhyped and expensive. I mean, there are a lot of opportunities in small cap stocks. There are a lot of opportunities in assets that have underperformed last year and over the last 5 years. If we're going to be pumping more money into the system, then conceivably the interest rates that have been kind of rising since September, conceivably they could come down, in which case some of the utility stocks look interesting. Some of them are down like 20% since September because they compete with treasuries. I am looking at under followed precious metals, and I'm invested in some. And they have done well, but I think they have room to go. So, I'm seeing a lot of opportunities across the board.
Awesome.
Hey, Mark, it's Rob. I have a quick question. Chris Brown, can you hear okay? The
Yeah, I'm here.
sorry if I missed your presentation. I've been in and out of things, but
There's 20 slides. Yeah.
okay. What's your quick take on PPP, and then I guess more so with respect to financial institutions going into forbearance mode still, or actually taking foreclosure. I'd be curious as to sort of the insurance institutional perspective on that. We do some distressed investing, as you might recall from the other event in the Midwest. Go ahead, Chris.
I can't say I'm an expert on PPP. We do have companies that we have lent to on a senior basis, a number of them that receive PPP loans. And there's been some nuances and difficulties with knowing for sure that those are going to be forgiven. For example, we've got a situation where a company is being sold in kind of a distressed situation, and if the PPP loan stays outstanding, there isn't enough to get all the secured creditors paid off. So there's kind of an issue with a holdback in that M&A process that tied to whether the PPP ultimately gets forgiven. But we've had other like amendment situations. I mean, I guess my experience with it in most situations, I mean, the companies are struggling. That's why they need the PPP. And so a lot of them have been in amendment processes. So, I mean, the PPP loans have been incredibly helpful to the companies that we've been involved with. But it's required additional structuring relative to amendments that those companies have needed.
Yeah, it's an interesting tension between, if the financial institutions or the banks take action versus their PR standing, both in community, and then even if you bring in the ESG side with respect to, with respect to taking action. So, I hear you. There's an interesting tension there.
Yeah, I think you're saying kind of headline risk, that you don't want to take aggressive action against an entity that kind of with their back against the ropes, that it could be a headline problem.
Yeah.
You mentioned that in April, Chris, that you were concerned how the bankruptcy system was going to function in light of trying to be, I guess, empathetic or to certain borrowers. But
yeah, you've got good notes, Mark. We actually didn't see that, or maybe a photographic memory. We didn't see that play out as much as we were concerned by it. We haven't seen as much of kind of folks holding back for headline risk problems, but certainly still an issue.
Has anyone here in the call actually done a workout of a commercial loan before, and the fun process that is involved with dealing with all of the legal documents? Yeah, it's no fun. And for those that do it, it's a real skill.
Unless you're Rob, Andy, that's where he's coming in with that dollar.
Well, I mean, if you come in, Andy, a little different. If you come in, with some principal capital and portfolio synergies versus just being a pure, financial buyer, that could be an economic difference that tilts your way, whether it's the Fulcrum security or just in these cases, basically stakeholders in either the restructuring or bankruptcy process. But it's Chris, to your point of headline risk though, but at some point, some of these financial institutions, they got to say, we got mouths to feed as well. And, it's a mega trend that a lot of people are saying second or third quarter that hopefully gets fleshed out a little bit more with vaccine.
Mm-hmm. We'll still welcome people's best ideas. I just threw on we've got, in addition to the weekly briefings, we've got Bill PowerPoint Deukler he's got the band back together on February 11th to talk about the latest in the virus, from the hedge fund to the venture to the pharma perspective. That'll be nice. We're going to continue this theme in our conference in February 23rd, 24th. We will have a second day to bring the Asians in. They're all complaining like, do you know what time it really is? You're inviting me to this thing. So we'll have the 8 a.m. start on the second day. Some really good people there because we talk about China. They can go to the nuances, and and as you can sort of see, some of you don't see this very often, but we do these on Tuesdays and Wednesdays, 10:30. People come up with new ideas, and then we move it to the on deck and then up to the calendar. So if you've got ideas, throw them in, and we got. So there's one on Korea, op zones. Now that the politics is over, I'm going to bring Lee Cooperman in for a little fireside, and then from Impact Guys, want to do the closed loop. Is in India, real estate. We're going to keep doing philanthropic deep dives. We had a really great event last week. Many of you are on. We're going to talk about the good, not bad, ugly, the catastrophic of the direct investing, and then UK, Europe. Now, you've been spending some time on the Biden agenda, Rob. If you've got, I think you don't want to chair it, but you will co-host it, co-champion it. Any takeaways from what you're seeing? You've been spending some time on that.
Yeah, you do have a good memory as to those specific details. Just on the Biden side, it's just interesting. One thing is policy, the other thing is emotion, and I think we talked a little bit about basically the mob approach there a week ago, 2 weeks ago. I'm glad that there was civility in the transfer, and I think in getting down to business now.
Governor.
Tracy.
Hold on. Is that me?
All my friends that are here.
Maybe
everything you've done for me.
That sounds like Biden. You got
And for my family.
You got good friends.
Out the years.
I don't know. Is that me?
Tommy, you've been a friend a long time.
Yeah, it's
coming out there, and
it's coming from your box.
I think he just commandeered the Zoom.
Keep going.
I don't know.
Deep state.
Yeah. I don't want to compete with the president, so let's say if it's but I think long and short is there's the COVID battles is his first battle, because that trickles into a lot of different things from healthcare to domestic spend, etc. And then what was the other thing I was going to make mention of? You caught me off guard here, but I think Biden's spending the right time, but he had to deal with this initial integration. There's unfortunately, a lot of work to be done just to get some of the cabinet approved in terms of Senate approval. That's going to take longer, just from normal protocol, and before he can get certain folks mandated to kind of go out and credibly address this on both sides of Capitol Hill. I guess the one other piece is the fact that it's a 50-50 Senate. I guess there's a planned sharing of power between McConnell and Schumer from New York. The vice president's going to have that vote in. So I think the good news is, and a lot of these Republicans that sort of saw this, they were kind of voicing both their support of the incoming administration and taking specific leadership to that, recognizing the need for power sharing. So I think there's going to be it's going to be an interesting honeymoon. I don't know how many months that lasts, but it's definitely going to be a honeymoon for a while. That's my 2 cents worth.
Fair enough. Any last thoughts before we have to? I got a hard stop at 1, 2. But particularly if anybody wants to get involved with this version 3 that we'll do in February, welcome that. Welcome interesting keynotes, etc. Welcome deals. Okay. Todd, you came all the way back here. You have a special deal you're working on that you're excited about, or you're on mute though.
You know what I like? You've changed your camera though. You used to have you used to be down here. Now you're right here. It's good. Because I film everything, right? And I just look back it's Todd Rupert. He's great, but you can't really tell it's Todd Rupert. You're still on mute though. And I don't know what happened with that.
So what I was saying is I do have something really exciting, but I'll have the deck next week. But it's a company out of Canada. You can go online. It's called hitlab.com. I'm on the board and I'm an investor, but we're launching the first ever global digital emerging artist showcase starting late February, and it's going to go around the globe. It's an AI company that's evaluating music to see what can be pop music, and it's all done through AI. It's fascinating, but I can send you stuff once I get it next week.
Well, Akshay, you're jumping off microphone because that was one of your questions recently, right?
Yeah, funny. I was looking at a company, a Swedish company actually called Snafu Records, which has an AI-based algorithm for identifying up-and-coming artists. They buy up rights from these artists and then hold on to them or resell them, and they provide all kinds of technology-driven marketing on top of that. I'm not sure I'm going to invest, but sounded exciting at least.
Interesting. There's a bunch of interesting stuff. Do you have information on them? Let's go in the chat here, and I'll swap stuff back and forth.
Oh, sure. I'm happy to send it to Mark.
And Todd, and actually, we have an app where you guys can
directly, of course,
directly connect.
Okay, I'll tell you. It's hitting the witching hour. I'll get you on the
Yeah, but all good. Look, it's been a great session. I'm sure Anders probably knows the Swedish company you're talking about, Akshay. So we'll keep these going. Come on Tuesdays too. We'll keep these conversations going, and we'll be back in a month to go deep on just this crowd.
Brilliant.
Okay.
Good idea. Hey, Todd, since you're a friend, if you put a tie on, you could actually pass for Biden if I have my glasses off.
I think
he's an okay-looking guy.
That's the right answer. I think Google Home is. I mentioned Biden, and suddenly Biden comes online. So that'll be the next theme. How much does Google know about us, really?
Way more than you want.
Yeah, I was going to say, what don't they know?
Yeah.
Keep it around. What have they missed?
Well, thank you, everybody.
All right,
thanks everyone.
Okay.
Thanks, Mark. Thanks, everyone.
Thanks, Mark. Bye.
Thank you, everybody.
Thank you.